Residual income is a dollar amount instead of the return on investment, which is a percentage. So we're looking at the desired minimum rate of return for the unit times the level of investment. It's the income earned by an investment center less a charge for the assets used to generate that income. So let's look at an example of residual income. So we have the average investment in the Midwest region at its net book value. We take the average investment times the minimum rate of return. We then calculate the difference between our actual income and the charge from the required rate of return times our investment, and we get our residual income. We can then compare organizations based on their residual income amounts. So now we can see that the residual income shows comparing the Midwest and the Boston area to South Florida. So the residual income calculation produces the same relative ranking as the return on investment does. That isn't always the case, but we still see that the Boston area is outperforming when you look at income to their investments. So advantages and limitations of the residual income measurement is that it helps us make better decisions about whether or not to reject projects where the ROI incentivizes us to reject them. We can look at minimum rate of return to adjust for differences in risk, and we can use a minimum rate of return for all different kinds of assets. The limitations are that when the rate of return is low, this favors the units that are bigger in size than other units. And it can be difficult to obtain a minimum rate of return at small subunit levels. If we use both return on investment and the residual income together, this helps create goal congruency. They're comprehensive financial measures, so it includes all of the elements of revenues, costs, and investment, and it's easier for us to compare a wide variety of these business units. However, of course, there are always limitations too. They're not as comprehensive as a balanced scorecard. So we're still not looking at customer satisfaction, internal processes, and other financial measures that were already linked to the strategy of the organization as a whole. And any accounting variations create changes in our numbers, in what determines profits and what determines how much is included in our investment measurements. Both of these are focused on short-term decision making and short-term measurement. The other measurement that we can use is called economic value added, or EVA. This is our income after taxes and after the cost of capital. This is our economic profit of an individual entity. It's similar to residual income in that it motivates us to increase our investments as long as the expected return is above the cost of capital. When we're calculating the economic value added, we take our after-tax cash operating income after depreciation. So our total pool of cash funds available to suppliers of capital. And then we have our revenues minus our cash operating costs minus depreciation minus cash taxes on operating income. K is our minimum rate of return, which can also be called hurdle rate, weighted average cost of capital, discount rate. So we're going to look at this. When we estimate the economic value added, we have to adjust our reported accounting numbers. So both our earnings and level of investment. Adjustments to capital are if we have a LIFO reserve, we have to make an adjustment for that. If we have research and development expenses and a bad debt reserve, we also need to look at any deferred income tax expense reserves. The adjustments that we make to our earnings are changes in deferred tax reserve, change in our LIFO reserve, bad debt reserve, and any unusual gains or losses. The last thing we talk about in Chapter 19 is transfer pricing. So transfer pricing is the cost that we use for intra-organization transfers or goods or services. So when we transfer items from one division to another. So transfer of products and services between business units is very common in firms with a high degree of vertical integration. What vertical integration is when we buy our suppliers in order to give us easier access to our suppliers. So rather than going to an outside unit to get components of direct materials or raw materials, we do all of this internally. When we're creating transfer pricing, of course, we're motivating managers, we're incentivizing them to make decisions that are consistent with the organization's strategy and goals, and we want to provide a basis for fairly rewarding managers. If we have international organizations and we're transferring from one country to another, then we can use transfer pricing to minimize our customs charges, minimize income taxes, to look at currency exchanges. And then, but we also have risk of expropriation, which would mean that the government would seize our items during transfer and we would not have access to them. That would really depend on which countries we're transferring items from. For this transfer pricing example, we have a high value computer company and we have the internal to the firm non-domestic. So from another country, we get parts and components. And then we have internal in the firm, we create this computer manufacturing unit, and then externally, we sell it out. And what is that transfer price when it moves from the X chip unit to the computer manufacturing unit? We have 4 different pricing models for transfer pricing. The first is the variable cost model, that we take the standard or actual variable cost with or without markup for a profit, and that is the transfer price. So if the variable cost is $20, the transfer price is either going to be $20 or we'll have a small markup so that manager shows a profit. If we go at full cost, then we transfer at the actual cost or the standard cost or at the full cost with markup. If we use the market price to calculate transfer pricing, then this is the price that we would get from outside sales if a market exists from our product. And the last is a negotiated price, which is internally negotiated between the managers of the different divisions. We can also have multiple methods for transfer pricing. This is called dual pricing. We want to use the most advantageous transfer price. One, we need to ask, is there an outside supplier? And then we need to know, is the seller's variable cost less than the market price? And is the selling unit operating at full capacity? what is the market demand for the outside product. When we look at the advantages and the disadvantages to the various pricing models, so using the variable cost, it's a low transfer price. It encourages our organization to buy internally and not look outside for the firm. This is advantageous to us when there's excess capacity. So when we have more than the market's willing to buy, then this makes sense. However, it's unfair to the selling unit because no profit is recognized on the transfer, which then can hurt their performance measurements because they're not earning anything on the transfer versus if they had earned something by selling it on the external market. Using full costs, of course, easy to implement. We already know what the full cost is. This is preferred by tax authorities, so the IRS. Limitations are that fixed cost is irrelevant in short-term decision making. And standard cost is a better choice than actual cost. For market price, this helps because we're providing the selling unit and we're being competitive. We're providing them the profit that they're looking for their performance evaluation, and we're being competitive. This is most often used when we don't have capacity and there's high demand for the product that we're transferring internally. So I'm not going to be, as a manager, incentivized to transfer it internally at a lower cost than I can sell it outside, especially depending on how my bonus or performance measures are calculated. It is the arm's length standard desired by international accounting standards. It doesn't work if our product has no market value outside of our corporation. So there's no market demand for it until it's connected with another component. And the negotiated price is this is most beneficial when we have internal conflict between managers or we have managers fighting about what is better for their unit versus what is better for the other unit. We need them to negotiate with each other. The problem is that we can create international tax problems if it's not considered an arm's length transaction. The market price gets us past that, and it can lead to dysfunctional decisions for the organization as a whole. So this is an example of different transfer pricing options for this computer company. So we have $85 a unit, which is the market price, or $60 a unit at the variable cost, or $72.50 per unit that is a negotiated price. And we can see that overall, the combined operating of the income of the organization is not affected, but the subunit income is affected. So that X chip unit, which is being evaluated as the seller, is has a very different operating income under each of the three methods. So when we look at this organization, we have to think, can this chip be purchased outside of the company, or can we only get it from internally? Are they at capacity or not? Okay. Any other information that we would use is the unit selling price of a computer, our variable manufacturing costs, the price of the chip sold to outside suppliers, the outside supplier price of the chip, the variable cost to make the outside chips compatible, and the variable selling cost for HBC to sell its chips. So is it better for us to transfer this chip internally or to sell it externally? And is it better for the other division to buy it from another supplier or to use the one that is potentially available internally? So if we look at this example, this is if we sell to an outside supplier. So then our X chip unit has a contribution margin of $4,950. If we sell internally, the X chip unit has zero contribution margin. So this is if we're using variable costing. So you can see how the computer manufacturing unit as a whole has a higher contribution margin if we do the internal transfer at variable cost. But under option 1, the computer manufacturing unit and the X chip unit together have a total income of $21,450. So if the X chip unit sells to an external supplier instead of doing an internal transfer at the variable cost, the company is better off. So this is a summary of that analysis. We have an outside supplier available to us. We have to consider the utilization of capacity for the computer chip unit, and we have to consider the contribution margin possible for selling that chip outside of the market. So therefore, this the computer chip is better if we sell it completely in the marketplace and we don't use it internally at all. So when we're looking at the relevant costs for decision-making purposes, we also need to think about out-of-pocket costs and opportunity costs. So based on the above, we would develop a general transfer pricing rule that the minimum transfer price is the incremental cost of the producing division plus the opportunity cost of the organization as a whole, if any, for internal transfer. So the general pricing rule is that we establish a minimum transfer price from the standpoint of the selling division, but look for the one that benefits the firm, the entire organization as a whole. We want to think about opportunity cost as it relates to the contribution margin versus selling externally or using internally. And then we have to think about international issues in transfer pricing also. So more than 80% of multinational firms see transfer pricing as a major international tax issue. And this is because international tax treaties have an arm's length standard as rules. So they require that transfer prices reflect the price that unrelated parties acting independently would have set for the transaction. So thinking about that as advantageous. So what's the comparable market price? What is the resale price method when little value is added and no significant manufacturing operations exist, or the comparable price method? So making sure that we meet those arm's length standards so we don't deal with international tax issues. So we look at applying that arm's length standard. We use the cost plus method. So this is based on the seller's cost plus a gross profit that's determined by the company. We would create advanced pricing agreements. So this is an agreement between the IRS and the firm using the transfer pricing to make sure that we're following that arm's length standard and we're not violating any tax treaty issues. Other considerations that we have to think about are currency translations, customs charges, transferring in, and then the possibility that a government could appropriate our assets. And that is the end of chapter 19.